I want to ask you something, and I need you to sit with this question for just a moment before we go any further. What if the single most expensive mistake you have made with your retirement savings had nothing to do with choosing the wrong fund, nothing to do with paying too much in fees, nothing to do with bad advice from a broker or a family member who meant well but didn't know what they were talking about? What if the most expensive mistake you have made, or are about to make, was something your own brain convinced you was the smart, responsible, logical thing to do at the time? What if the enemy of your retirement security was not the market, not inflation, not even Social Security running short, but the very instincts that have kept human beings alive for thousands of years, now quietly working against you every single time you open a financial app or read a headline about the stock market? I know that sounds dramatic. I know it sounds almost unbelievable. But I am going to show you today, with 8 years of real data from one of the largest investment companies on earth and decades of independent research from one of the most respected financial analysis firms in the country, that this is exactly what is happening to millions of everyday retirees and near retirees right now. And by the end of this video, you are going to understand not just what is happening and why, but exactly what to do about it, including one approach that most financial professionals never explain clearly enough, an approach so simple and so counterintuitive that when I tell you what it is, your first reaction might be to think I am joking. But I am not, and the data backs it up completely. My name is Robert, and on this channel, I take the complicated, the buried, and the misunderstood, and I put it in plain English so that you can protect the retirement you spent your whole life building. Before we go any further, I want you to type your age in the comments below and tell me your biggest financial worry right now. Is it watching your savings bounce around with every news headline? Is it prescription costs or medical bills eating into what you thought would be a comfortable retirement? Is it fear that the market is going to collapse right when you need the money the most? Is it trying to figure out when to claim Social Security, when to draw from your 401k, and whether your money is going to last? Tell me, because you are not alone. And what you share down there helps me make sure every video on this channel speaks directly to what you actually need to hear. Now let me start with the study, because this is where everything begins, and it is genuinely one of the most revealing pieces of research I have ever come across in all my years of studying retirement finance. Vanguard, which manages trillions of dollars in assets and serves millions of everyday investors, including an enormous number of retirees and near retirees, conducted a survey of their own investors for 8 consecutive years. And the question they asked was straightforward. What do you think the stock market is going to do over the next 12 months? Up, down, sideways? Just tell us your prediction. Now, I want you to think about that for a moment before I tell you what they found. These are not random people pulled off the street. These are people who are actively invested, people who are paying attention to their money, people who care enough about their financial future to have an account with one of the most respected investment firms in the world. So were they good at predicting what the market would do? Were they at least in the right direction most of the time? The answer, documented across 8 full years of data, is no. Almost every single year, the investors got it wrong. But here is where it gets truly fascinating, and I need you to hear this carefully because this is the part that changes everything. The predictions were not wrong in a random, scattered way. They were wrong in a very specific, very consistent, and very predictable pattern. And that pattern, once you see it, you cannot unsee it. And more importantly, once you understand it, you can stop it from costing you the retirement you have worked your entire life to build. Here is what Vanguard found year after year without exception. The single strongest predictor of what investors thought the market was going to do next was not economic data, not interest rate trends, not corporate earnings reports. It was simply what the market had done over the past 12 months. If the previous year had been strong, investors overwhelmingly predicted that the market would continue rising. If the previous year had been painful and the market had dropped significantly, investors overwhelmingly predicted that the market would continue falling. And they were almost always wrong in exactly that way. Behavioral scientists have a name for this pattern. It is called extrapolation bias, which is simply the tendency to take whatever just happened and assume it is going to keep happening. Let me show you exactly how this played out in real life with real numbers, because the abstract becomes very concrete when you put dates and percentages on it. Think back to late 2021. The S&P 500 had delivered an extraordinary return of roughly 28% that year. Investor sentiment surveys were at sky-high levels. People felt optimistic, energized, confident. The prediction from the majority of investors was that the market would continue its upward march. And then 2022 happened, and the S&P 500 dropped approximately 18% in one of the worst calendar years for investors in recent memory. Now flip it around. By the end of 2022, after that brutal year of losses, investor sentiment had cratered to near historic lows. People had just lived through 18 months of painful declines, and their predictions reflected that suffering. The consensus was deeply pessimistic. Brace for more losses. The worst is not over. And then 2023 arrived, and the S&P 500 rallied nearly 24%, delivering one of the strongest years in recent history. The investors who were most bearish, most convinced the pain would continue, were sitting on the sidelines in cash or in conservative positions right when the recovery exploded upward. This is extrapolation bias in action. And if you are making financial decisions based on how you feel about where the market is going, it is not just intellectually frustrating. It is financially devastating in a way that compounds over years and decades. Now, I want to pause here and say something that I mean sincerely, because I think it matters enormously for how we process this information together. Your brain is not broken. You are not being irrational in any shameful or embarrassing way. You are being human. And understanding why your brain does this is the first step to working with it instead of against it. Behavioral scientists point to something called recency bias, which describes the well-documented tendency of human minds to assign greater weight and importance to recent events than to older ones. And from an evolutionary standpoint, this was not a flaw. It was a feature. If you were a hunter-gatherer and a predator appeared at your water source yesterday, assuming that predator might appear again today was not paranoia. It was survival intelligence. The problem is that the stock market is not a predator at a water source. The short-term movements of financial markets are notoriously unpredictable in ways that human intuition is simply not wired to handle well. There is also a related concept called the availability heuristic, which describes the way our minds judge the likelihood of an event based on how easily and vividly we can recall an example of it. A dramatic market crash, like 2008 or early 2020, creates an intense emotional memory that our brains treat as evidence that such crashes are common and likely to repeat. But a slow, steady, decade-long upward climb in the market, which has actually been the dominant pattern across most of market history, does not create that same vivid emotional imprint. Our brains systematically overweight the dramatic and underweight the gradual, even when the gradual is actually more representative of long-term reality. This is not a character flaw. It is neuroscience. But knowing it exists is what gives you the power to counteract it. Let me tell you about a man named Raymond. Raymond is 69 years old, a retired electrician from Pennsylvania who spent 38 years working union jobs and contributing faithfully to his 401k every single paycheck. By the time he retired, Raymond had built a nest egg he was genuinely proud of. But in late 2022, after watching his account balance drop month after month for almost a full year, Raymond made a decision that felt, at the time, like the wisest and most responsible thing he had ever done. He moved the majority of his retirement savings into a money market account. Safe, stable, protected. He told himself he would move it back when things calmed down and the market showed some signs of recovery. What Raymond did not know, and what no one had explained to him, was that the recovery was already beginning. 2023 delivered gains that Raymond sat out almost entirely, watching from the sidelines in his money market account while the market climbed 24% without him. Raymond later estimated that his decision to protect himself from the storm cost him somewhere between $30,000 and $40,000 in gains he never captured. He did not make that move out of panic or foolishness. He made it because his brain, doing exactly what human brains are designed to do, told him that the pattern of the recent past was the most reliable guide to the near-term future. And his brain was wrong. Raymond's story is not unusual. It is, in fact, precisely what the data predicts will happen to millions of investors in exactly these circumstances. And I want to show you the numbers behind Raymond's story, because this is where it stops being anecdotal and becomes something you can feel in your bones. Morningstar, one of the most respected independent investment research firms in the world, publishes an annual study called Mind the Gap. And what this study does is compare two numbers. The first is the return that a fund actually earned over a given period. The second is the return that the average investor in that fund actually experienced during the same period. And those two numbers, you might assume, would be the same. They are almost never the same. Over the 10-year period ending December 31st, 2024, the average dollar invested in U.S. stock funds and exchange-traded funds earned approximately 7% per year. But those same funds, as investments, actually earned approximately 8.2% per year. There is a gap of 1.2 percentage points, and Morningstar's research conclusively attributes that gap to investors buying and selling at the wrong times, moving money in when sentiment was high and pulling it out when sentiment was low, in a pattern perfectly consistent with everything Vanguard's 8-year study revealed. Now, 1.2% might sound like a rounding error. Let me show you why it is not. Morningstar found that this 1.2 percentage point gap represents roughly 15% of those funds' total return over the 10-year measurement period. Investors were leaving 15 cents of every dollar of potential return on the table, not because of bad funds, not because of high fees, but purely because of the timing of their own decisions. And this gap was not a one-time aberration tied to a specific unusual market environment. Morningstar found it consistently across every 10-year period ending in 2020, 2021, 2022, and 2023. This is a durable, repeatable, human behavioral pattern that shows up decade after decade without fail. Let me make this concrete with numbers that might look very familiar to your own situation. Imagine you invested $100,000 in a diversified U.S. stock fund 10 years ago. If you had simply left that money alone and earned the fund's actual return of 8.2% per year, your investment would have grown to approximately $219,000. But if, like the average investor in those funds, you had moved money around based on market sentiment and gut feelings and earned the average investor return of 7% per year instead, you would have ended up with approximately $197,000. That is a difference of $22,000 on a single $100,000 investment over 10 years. $22,000 that belonged to you, that you had earned by choosing good funds and staying invested, but that slipped away because of the timing of the decisions your brain convinced you were smart. For a retiree or near retiree, $22,000 is not an abstraction. It is years of Medicare premiums. It is a roof repair. It is the cushion that means you can help a grandchild or handle a medical emergency without lying awake at night. And there is one more piece of data I need you to hear before we talk about what to do, because this one is the most dramatic illustration of all. An investor who stayed fully invested in the S&P 500 across the entire 20-year period from 2003 to 2023 earned approximately 9.8% per year on average. But an investor who missed just the 10 single best trading days across that entire 20-year stretch, 10 days out of more than 7,300 total trading days, saw their annual return cut nearly in half, falling to approximately 5.6%. 10 days, less than 2 weeks of total market time, spread across 20 years. That is how concentrated the gains of a long-term investment are. And here's the part that makes this devastating in a specific and predictable way. Those 10 best days do not occur during calm, pleasant, optimistic market environments. They cluster during and immediately after the scariest, most volatile, most stomach-dropping moments in the market. The biggest single-day recoveries tend to happen right in the middle of, or right on the heels of, the biggest crashes. Which means the investor most likely to miss those 10 best days is exactly the investor who looked at their account during the most frightening period, felt the full force of recency bias and extrapolation, telling them that the pain would continue, and moved their money to safety. And in doing so, they protected themselves from the last of the losses and robbed themselves of all of the recovery. This is where I need to pause for just a moment. If you are finding this helpful, if this is clarifying something that has felt confusing or frightening or overwhelming about your retirement savings, please hit that subscribe button right now and tap the bell so you never miss a video from this channel. And stay with me, because what I am about to share is the part that most financial content never explains simply enough. It is the insight that once you understand it, makes the entire picture fall into place. And it is genuinely one of the most hopeful and empowering pieces of information I can share with anyone who is trying to make their retirement savings last. So we have established that market predictions are almost always wrong, that they are wrong in a consistent and predictable direction driven by identifiable features of human psychology, and that acting on those predictions costs real people, real money, year after year, decade after decade, without exception. So what is the solution? Here is where I get to tell you something that sounds almost too good to be true, but that is backed by more rigorous research than almost any other principle in personal finance. For most people, in most circumstances, the answer is to do nothing. I mean that seriously, completely, and with full scientific backing. Deliberate, intentional inaction is one of the most powerful forces available to any investor, and it is profoundly undervalued precisely because it sounds passive. Behavioral economists have a term for this force. They call it inertia. And Andy Reid, the head of behavioral economics research at Vanguard, put it in terms that I think are worth hearing exactly as he said them. Nothing is the most powerful force in behavioral finance. What he means is that inertia, the tendency of things to stay in the state they are already in, can be deliberately designed to work in your favor. And when it is, the results are remarkable. Let me tell you about a woman named Evelyn. Evelyn is 73 years old, a former kindergarten teacher from Georgia who retired at 66 after 30 years in the classroom. Evelyn's school district had automatically enrolled her in a 403B retirement plan early in her career, something she barely remembered signing up for. She contributed a modest amount every month for decades, and because the account was set up with an automatic annual contribution increase and a target date fund that rebalanced itself, Evelyn essentially never had to make an active decision about her retirement savings. She watched the news during 2008 and felt terrified. But she did not have an easy mechanism to move the money around, so she left it alone. She watched the sharp COVID crash in early 2020 and felt her stomach drop, but again, inertia kept her in place. When Evelyn sat down with a financial counselor at 65 to plan her retirement, the counselor told her that her account had grown to a level that genuinely surprised both of them. The automatic features, the consistent contributions, the self-rebalancing fund had compounded quietly and powerfully across 3 decades of market cycles, crashes, and recoveries. Evelyn told that counselor something I find deeply moving. She said, "I always assumed I wasn't smart enough about money to have done it right. I didn't realize that not doing anything was the right thing." Evelyn's experience is not luck. It is the precise outcome that decades of behavioral finance research predicts for investors who build good automated systems and then get out of their own way. And let me show you exactly how this works in practical terms that you can apply starting this week. Target date funds are one of the clearest illustrations of inertia working in an investor's favor. You choose a single fund matched to the approximate year you plan to retire, and that fund automatically holds a mix of stocks and bonds, automatically shifts to a more conservative allocation as you approach retirement, and automatically rebalances itself to maintain that allocation through every market movement. You make no decisions. You take no action. The fund does it all. And research consistently shows that investors in these simple, automated funds come far closer to capturing the full return of the market than investors in more complex funds that invite more active decision-making. Dollar cost averaging works the same way. When you invest a fixed amount every month, the same amount, regardless of what the market is doing, you are buying more shares when prices are low and fewer shares when prices are high, automatically and without any decision required. You are not trying to predict anything. You are simply participating consistently, which is exactly what the data says produces the best outcomes over time. And automatic rebalancing, available in most modern retirement accounts, ensures that your portfolio never drifts too far from your intended allocation without requiring you to monitor it actively or make timing decisions. You set the rule once, and the system enforces it for you. Now, I want to be clear about something important, because there is a meaningful difference between deliberate inertia and simply ignoring your retirement savings entirely. Doing nothing productively means having a good structure in place first, a diversified allocation appropriate for your age and risk tolerance, automated contributions if you are still working, automatic rebalancing, and low-cost funds, and then deliberately not interfering with that structure every time a headline makes you nervous. But doing nothing when your portfolio has never been properly set up, or when you have been defaulted into a money market account that is not actually growing, or when your allocation drifted years ago and was never corrected, that is a different situation entirely. So let me walk you through exactly what to look at and what to do, because this is where information becomes action. The first thing to do is check where your money actually is right now. Many people, especially those who rolled over old 401k accounts when they changed jobs or retired, find that their money has been sitting in a default money market or stable value fund, earning almost nothing, sometimes for years. Open your account, look at what you are actually invested in, and make sure it is appropriate for your situation and your timeline. The second thing is to check whether your allocation has drifted significantly from where you intended it to be. If strong market performance over recent years has pushed your stock allocation far higher than you planned, your portfolio may now carry more risk than you are comfortable with, and a rebalance back to your intended allocation is worth considering. Crucially, this rebalancing should be done according to a predetermined rule or schedule that you set in advance, not as a reaction to recent market movements. You are not trying to time the market. You are maintaining the structure you deliberately designed. Third, if you are still contributing to a retirement account, make sure those contributions are automated and that the contribution amount increases automatically over time if your plan offers that feature. And fourth, and this is the one I want you to really hear, turn on every automated feature your account offers. Automatic rebalancing, automatic contribution increases, target date fund allocation. Remove as many decision points from your ongoing financial life as possible. Because every decision point is an opportunity for your very human, very well-intentioned brain to do something that feels smart and costs you money. The fewer decisions you have to make, the better your outcomes are likely to be. The research on this is overwhelming and consistent. Let me tell you about one more person before we close, because this story speaks directly to something that I know weighs heavily on many people watching this right now. Harold is 67 years old, a retired truck driver from Tennessee who spent his working years in a physically demanding job that left him with some health challenges and a retirement account that he had largely neglected because he assumed he had not done enough to make it worth paying attention to. When Harold finally sat down to look at his finances after retirement, he was convinced he had made too many mistakes to recover from. He had moved money around during the 2008 crash and missed part of the recovery. He had stayed out of the market for almost 2 years in his mid-50s because the news had frightened him. He felt, as he described it, like someone who had played a long game badly and was now paying the consequences. What Harold discovered, with help from a nonprofit financial counseling service, was that despite the mistakes he believed he had made, the money he had left untouched and invested consistently across 30 years had compounded in ways he genuinely had not imagined were possible. The mistakes felt enormous to Harold. Mathematically, the decades of consistent participation had been more powerful than the mistakes. Harold also discovered that he qualified for a Medicare savings program he had never known about, which eliminated his Part B premium entirely, saving him nearly $250 a month. Combined with extra help for his prescription costs, Harold's fixed monthly expenses dropped by over $400, which meant the retirement savings he had were suddenly sufficient in a way they had not seemed to be before. Harold told the counselor that the two things that changed his retirement, understanding how his investments actually worked and discovering the programs he had never been told about, were both things nobody had ever sat him down and explained. He had not been failed by his own intelligence. He had been failed by a lack of clear information. And that is exactly what I am here to change. Here's the whole picture brought together, because I want you to leave this video not just informed, but genuinely equipped. The market does not care what you think is going to happen next. 8 years of Vanguard survey data and decades of Morningstar research tell a story that is remarkably consistent across every market environment, every economic cycle, every generation of investors. The investors who come closest to capturing the full return of the market over long periods are not the ones who predicted the future most accurately. They are the ones who stopped trying to predict it all, who built a solid, diversified, automated structure, and then deliberately protected that structure from their own very human instinct to act when acting felt necessary. And for retirees and near retirees specifically, this principle connects to something even larger. Because your financial security in retirement is not determined by any single decision you make. It is determined by the combination of your investment approach, your Social Security claiming strategy, your Medicare and supplemental coverage choices, and the programs and benefits you may be entitled to but have never been told about, including Medicare savings programs, extra help for prescription costs, SNAP benefits for groceries, state property tax relief programs, and more. These programs stack together. They work in combination. And for many seniors, discovering and enrolling in even 2 or 3 of them can reduce monthly expenses dramatically enough to change the entire picture of what their savings need to do. You are not behind. I want to say that clearly and directly to you because I know how many people watching this have spent years carrying a quiet sense of shame or fear about whether they made the right decisions, whether they saved enough, whether they are going to be okay. The research tells us that the financial outcomes that matter most are shaped far less by the decisions you made in the past than by the structure you put in place going forward and the benefits you claim starting now. The window is not closed. The options are not gone. The programs exist, and you are entitled to them. The knowledge that changes everything is available to you right now, today, in this video, and in every one that follows it on this channel. What I need from you is simply this. Stay curious. Stay engaged. Keep asking questions. And if someone you care about, a spouse, a sibling, a friend, a neighbor who is navigating retirement and feeling overwhelmed or confused or afraid, please share this with them. Because the moment someone understands how this works, really understands it, everything changes. The fear does not disappear overnight, but it starts to be replaced by something better. Something that looks a lot like confidence. And confidence, at this stage of life, is not a luxury. It is a right. You earned it. Now let's make sure you keep everything else you earned along with it.